Navigating the world of investments can be challenging, especially when you're trying to find the best ways to maximize your returns. In this video, we'll explore 5 key investment concepts: the rule of 70, net present value, internal rate of return, payback period, and total return. We'll provide examples and explanations for each concept to help you make informed decisions and manage your investments more effectively. Let's dive in! Rule of 70, a simpler alternative to Rule of 72. The Rule of 70 is similar to the Rule of 72 but uses 70 instead of 72. It's less accurate but can be helpful in situations with lower interest rates. For example, if you invest in a savings account with a 2% annual interest rate, the Rule of 70 estimates it will take 35 years, 70/2, for your investment to double. Keep in mind that the Rule of 70 is just an approximation and should be used with caution. Net present value, measuring an investment's profitability. Net present value is a method used to evaluate the profitability of an investment or project. It calculates the difference between the present value of expected cash flows and the initial cost of the investment. Suppose you're considering investing $10,000 in a business project that is expected to generate $3,000 per year for 5 years. Using a discount rate of 5%, the NPV for this project would be $1,863.15. A positive net present value indicates that the project is expected to generate a profit. Internal rate of return, comparing investment opportunities. The internal rate of return is the discount rate that makes the net present value of an investment equal to 0. It's a way to measure an investment's profitability and is often used to compare different investment opportunities. For example, you're considering 2 investments. Investment A has an IRR of 8%, while Investment B has an IRR of 12%. Based on the IRR, Investment B is expected to provide a higher return and may be a better choice. Payback period. How quickly will you recover your investment? The payback period is the time it takes for an investment to recover its initial cost through the cash flows it generates. It's a simple and quick measure of profitability, but it doesn't consider the time value of money. For example, if you invest $50,000 to start a new business and expect to generate $10,000 in profit per year, the payback period would be 5 years, $50,000/$10,000. This gives you an idea of how long it will take to recoup your investment. Total return, evaluating your investment's overall performance. Total return is the overall profitability of an investment, including interest, dividends, and capital gains, expressed as a percentage of the initially invested amount. For example, if you invest $1,000 in a stock and earn $200 in capital gains and $100 in dividends, your total return would be 30%, $300/$1,000. This allows you to analyze the performance of your investment over time. Understanding these 5 key investment concepts can help you make better informed decisions and maximize your returns. By utilizing the Rule of 70, net present value, internal rate of return, payback period, and total return, you can evaluate and compare different investment opportunities, assess the profitability of projects, and monitor the overall performance of your investments. Remember that each concept has its limitations and should be used in conjunction with other financial metrics and analysis tools to get a comprehensive view of your investments. As you continue to explore the world of investments, keep these concepts in mind and don't be afraid to seek guidance from financial professionals. By educating yourself and staying informed, you'll be well equipped to make sound investment decisions and grow your wealth over time. So, get out there, start applying these concepts, and watch your investments flourish. And don't forget, join our community by subscribing and hitting the notification bell for more content like this. Thanks for watching!